Hey, do you remember when Graham Stephan and Ian Lopa congratulated me on my 100th share of PepsiCo in May of 2022?
What's up, you guys? It's Graham here. So, Russ, I want to congratulate you on getting to 100 shares of Pepsi. That is fantastic in 100 weeks. Well done.
Hey everyone, it's PPC Ian. I am here today to congratulate you, Russ, on your accomplishment of accumulating 100 shares of PepsiCo over the course of 100 weeks. Brick by brick by brick, you did it.
Hey, if you don't remember that, don't worry. It was almost 3 years ago. But man, am I eternally grateful for the one and only PPCE and Ian Lopik for creating that message for me. But things have changed and I just made a big move with the taxable portfolio. Hey, what's going on? I'm Russ, your blue-collar dividend growth investor. And before we dive in, here's a really quick reminder that you can follow my journey on DapperDividends.com, where you can check out the 3 portfolios that we share. And there you can also sign up for the fantabulous free weekly newsletter where I share some investing thoughts and all the weekly portfolio moves. And if you want to see my trades as they happen, follow me on Blossom, where everything is posted there for free and all the links for these are in the description below. So I'll be sharing my costly mistake that I made with PepsiCo, ticker PEP, and Johnson Johnson, ticker JNJ, in the taxable account. And yes, they're both dividend kings, but sometimes royalty has to go. So here's what happened. Our 2011 GMC Acadia hit 170,000 miles, and suddenly we're on a first name basis with our auto mechanic. I mean, that's never a good sign. And in May of 2024, we started looking for a new family car, and in October, we found a 2021 top of the line VW Atlas racing green with 47,000 miles. Now, we usually go for older cars, but hey, sometimes you gotta treat the family. So here's where I messed up. We decided to sell Johnson & Johnson and PepsiCo out of our taxable account to pay for this new car whenever it was that we decided to buy it. But I got greedy instead of selling right away. I thought I'd be clever and hold on for a few more dividend payments and even maybe catch the stock price going up a little bit. Big mistake. While chasing a few $100 in dividends, I watched these stocks drop way more than those dividends paid. Talk about penny wise and pound foolish. Now, what I should have done was move that money right away into a high yield savings account or a money market fund like the Schwab Value Advantage Money Fund, ticker SWVXX. And check this out, instead of taking losses, I would have had a safe total return of almost 3%, and yes, that's counting the J&J and PepsiCo dividends I was holding out for. So the first big lesson I learned, and boy did I learn it the hard way, is any money you know that you will need to use in 2 to 3 years should not be in the stock market, period. So consider this my tuition payment to the market, and I'm sharing this lesson with you for free. Now, the second lesson is we got the Atlas with a 7.69% interest rate loan. I mean, think about this. We paid $292 in interest for a couple months because I was sitting on those stocks as they started going down, thinking, hey, they'll come up, plus I'm going to get a few dividend payments along the way. I mean, that was guaranteed money coming out of my pocket, so paying off any loan guarantees you a return of its interest rate. Now, we're going to look at Johnson & Johnson and PepsiCo, and I think they're great companies, but they're kind of like your grandparents. They're old, they're mature, they're super reliable, we would hope, but not exactly built for speed. Let me show you what I mean. Now, as of this recording, December 19th, PepsiCo has been beaten down, and it closed at $151.47, way down at a 52-week low, but it does have a dividend safety score according to Simply Safe Dividends, where you're going to see this information from, of 93, very safe. They are a dividend king, meaning that they've been raising their dividend for at least 50 consecutive years, which is one hell of an achievement. And their last dividend raise was 7.1% in February of 2024, and they have an 11% 20-year CAGR. And PepsiCo is currently paying out $5.42 of dividends per share per year. According to Simply Safe, they think that they are undervalued. They expect a price of $184 to $224, so could be a good time to buy and hold if you believe in PepsiCo. And as a dividend growth investor, as a value investor, these are a few of the very surface level metrics you like to see, is when the dividend yield is sky high above above the 5-year average, and the forward price to earnings ratio is way below, but it's going to be on a case-by-case basis, and you can't just go and buy any company for that because, hey, if they've deteriorated and they might be going out of business in the near future, not something you're going to want to be holding. Now, one of the bugaboos with PepsiCo that worried me was in 2022 when their free cash flow payout ratio, because the dividend is paid out of free cash flow, hit 111%. It came down to 86. The last 12 months, back way up to 116%. A big blue chip mature company like PepsiCo, from what I've seen, can do this for a little while, but not indefinitely. And analysts do predict that they are going to be okay and that it will be at 70% in the next 12 months. But all in all, we would love to see this number below 70%. Gives them some wiggle room so the dividend can have room to be increased for the future. And this is one of the things that I don't really like to see is that their free cash flow per share, $5.07 in 2014. It was $4.51 the last 12 months. And you can see the cyclicality where we're up and down and up, and just you want to see that steadily going up and to the right instead of this chopping sideways, which I think is why the share price has kind of languished. But earnings per share has still gone up and to the right, although I think this is more of a financially engineered number because things like share buybacks can affect this. No sales growth the last 12 months. They've really slowed down buying back shares, 1.38 billion outstanding, but they had 1.39 billion in 2020, although their total sales have continued to climb up and to the right. Now their margins look okay, 20% return on invested capital. That's a good number. We'd like to see that, as well as return on equity, but we know that debt can affect return on equity as well. Last 12 months free cash flow margin, 7%. That means out of every $1 coming into the business, 7 cents is making its way down to free cash flow. And with the free cash flow, you can pay the dividend, you can buy back shares, you can carry it as cash on the balance sheet, or you can reinvest in the business. So that's just an okay number. We'd love to see that in double digits like some of the really highly profitable businesses such as Visa. Their net debt to capital, 65%. Net debt to EBITDA, 1.95. This means if they focused all of their earnings before interest, taxes, depreciation, and amortization, it would take almost 2 years. It would take 1.95 years to completely wipe out the debt, which is pretty low. And they have really good interest coverage ratio. If you're new and you don't know what the ICR is, this means how many dollars of operating income does a company have to cover every $1 of interest on the debt. PepsiCo currently can easily cover the interest on the debt with $15.33 of operating income, or EBIT. Flipping on over to J&J, dividend safety score of 99. Very safe. That's the highest rating. They are also at a 52-week low. You see from the notes here, Simply Safe Dividends believes that J&J is still going to be okay. So they have maintained that 99 safe dividend score. J&J, of course, is a dividend king with 61 years of consecutive increases. Not as fast as PepsiCo. They have an 8% 20-year CAGR, and they last raised that dividend 4.2% in April of 2024. And as of this recording, they're paying $4.96 per share per year. Now, Simply Safe Dividends thinks that J&J is also undervalued. They expect a price range of $164 to $200, currently at $143, so looking to be undervalued according to Simply Safe. Same stuff as PepsiCo. Dividend yield way above the 5-year average, and the forward PE is below. Look at that. The 5-year average dividend yield is 2.73%, currently at 3.45, which if my Cook County education tells me right, and the app on my phone, it's about 26.4% above the 5-year average. We'll go a little bit quicker here. J&J's free cash flow payout ratio was a little bit more elevated than normal. Usually it's in the low 50s. Lately, it's been in the high 60s, so that's a little bit high for J&J. Looking to be about 61% for the next 12 months, as it was the last 12 months. I like that free cash flow per share, a little bit better than PepsiCo, although it's taken a bit of a tumble in 22, and it has recovered to another all-time high at $7.90, and the analysts expect it to go up to $8.19 in the next 12 months. Mid-single digit sales growth, that's not too shabby, and that's kind of the high end going going back 10 years. You saw they were at that in 2017 and 2018. Now they do buy back shares a little more aggressive than PepsiCo, down to 2.43 billion shares outstanding, and their total sales at an all-time high again of 87.7 billion. The ROIC, the return on invested capital, similar to PepsiCo at 21%, which is also their return on equity. Much better free cash flow margin. Remember, PepsiCo is at 7%, J&J 22%. So remember, 22 cents out of every $1 coming in the door is finding its way to free cash flow, which is very nice. Yeah, and they have very low debt. So this is a very strong company. And Microsoft and Johnson Johnson are the only two companies that are AAA rated, which is higher than the US government. And the ICR, $30.10 of operating income to easily cover every $1 of interest on the debt. And both of these companies are facing some serious headwinds right now. J&J is dealing with those talc lawsuits, and PepsiCo's investors are worried about how these new weight loss drugs might affect its snack sales. And then we got hit with all this uncertainty about potential changes in health and food regulations after the US election cycle. And if there's one thing the market hates, it's uncertainty. Because when that happens, stocks drop first and then ask questions later. And I want to tell you about Dividend Kings. Don't get wrapped up in that name. It's just a title. You don't need to look any further recently than 3M, VF Corp, ticker VFC, and Leggett & Platt, ticker LEG, all former Dividend Kings that had to cut their dividends. And some current kings barely increased their dividends. I mean, seriously, you need a microscope to see Emerson Electric's latest dividend raise. Now, these investments weren't all bad. Look at PepsiCo. My adjusted cost after all dividends and options income was $129.35, which is way below my purchase price of $150.37. That is the power of dividend growth investing with a little options strategy mixed in. And even though I realized a 1.6% loss on Johnson Johnson, we still came out positive when factoring in all the dividends we received throughout the years. On December 16th, 2024, I finally did it and sold everything. 113 shares of J&J at $146.75 and 100 shares of PepsiCo at $158.08 for a grand tiddly total of $32,389.81. And just a shade over $32,000 is what we ended up paying for the Atlas, but we also did buy a $2,500 extended warranty. So for 5 years, if anything breaks, that's normal wear and tear. They will replace it with no added cost. So moving forward, we're going to be paying ourselves back $200 a week, but with a little bit different strategy. Likely laying a foundation of VTI, the Vanguard Total Stock Market Fund, because let's face it, I'm not any smarter than the market. We'll be focusing on companies that I think I understand, looking at dividend growth companies such as Visa and Costco, because we're in our 40s and we still have a lot of time to let those dividends grow and compound. And probably some midstream MLPs like Enterprise Products Partners, ticker EPD. More on that in a moment. So the big takeaway here is you need to answer two questions before investing or starting any portfolio. One, when do I need this money? And two, what is the goal? Growing wealth or preserving it? That's a huge one. Are you in the wealth accumulation phase or the wealth preservation phase? Because if we were in the wealth preservation phase, J&J and PepsiCo would fit like a glove. Now remember, I'm just a welder slash service technician slash installer, sharing some things that I've learned. I do not have a fancy finance degree. I barely graduated a Cook County high school, and all I have are just over 6 years of learning from my investing mistakes and my wins. But if I can do this, you can absolutely do this too. And if this helped you, tippy tap that like button. Remember, we're all climbing this investing ladder together. I'm going to share with you a really important lesson that I learned about MLPs like Enterprise Products Partners and why holding them in a self-directed IRA or a Roth IRA or any tax-advantaged account is very suboptimal. So if you click this floating little box next to my head, I'll tell you all about it there.